Investing is a key element of personal financial growth, offering the opportunity to increase wealth over time by putting money into assets that have the potential to generate returns. For many people in the UK, investing in stocks and shares is one of the most common ways to achieve this. Stocks represent a share in the ownership of a company, and by purchasing them, you become a part owner of that business. This ownership entitles you to a share of the company's profits, usually paid out as dividends, as well as the potential for capital growth if the value of the stock increases. An investment in stocks is generally considered riskier than holding money in savings accounts, as the value of stocks can fluctuate due to market conditions, company performance, and broader economic factors. However, stocks have historically provided higher returns over the long term compared to other forms of investment. The stock market can be volatile in the short term, with prices rising and falling based on investor sentiment, global events, and corporate results. Despite this volatility, many investors look to the stock market as part of a long-term strategy to grow their wealth. Investing in the stock market can be done through various channels. Individual stocks can be purchased directly from a stockbroker or an online trading platform. When buying shares, it is important to understand that the value of your investment can go up or down. Some companies may pay dividends, providing a regular income stream in addition to any potential increase in the stock's value. However, dividends are not guaranteed and may vary depending on the company's performance. For those who prefer a more diversified approach, investment funds provide a way to invest in a range of different stocks and other assets. A popular option in the UK is the Unit Trust, or Open-Ended Investment Company, OEIC. These funds pool money from many investors and spread it across a variety of assets, such as shares, bonds, and other securities. This diversification reduces the risk associated with investing in individual stocks, as the performance of one company or asset will not have as much impact on the overall fund. Fund managers make the investment decisions on behalf of the investors, which can be an advantage for those who do not have the time or expertise to manage their own portfolios. Another way to invest in the stock market is through index funds or exchange-traded funds, ETFs. These funds aim to replicate the performance of a specific stock market index, such as the FTSE 100, which tracks the top 100 companies listed on the London Stock Exchange. Index funds and ETFs are often considered a low-cost way to gain exposure to a broad range of stocks, as they are passively managed, meaning there is no active selection of stocks by a fund manager. Because of their broad exposure, they offer a more stable return over the long term compared to investing in individual stocks. For investors in the UK, tax-efficient investment vehicles such as individual savings accounts, ISAs, are available. Stocks and shares, ISAs, allow individuals to invest in a wide range of assets, including stocks, bonds, and funds, without paying tax on the returns. Each year, there is an ISA allowance, which limits the amount you can invest tax-free. For the current tax year, this allowance is £20,000, providing a significant incentive for those looking to build a tax-efficient investment portfolio. When investing in stocks, it is essential to have a clear understanding of your risk tolerance and investment horizon. Stocks are typically more suited for those with a long-term view, as the stock market's inherent volatility can result in short-term losses. However, the potential for higher returns makes it a valuable option for those willing to accept the risk. A diversified portfolio, which includes a mix of stocks, bonds, and other assets, can help mitigate risk while maximizing potential returns. Research and analysis play a critical role in successful investing. When considering which stocks to invest in, investors often look at a company's financial health, its market position, growth potential, and broader economic trends. Some investors prefer to focus on large, well-established companies that are seen as safer, often referred to as blue-chip stocks. These companies are usually leaders in their industries, offering reliable returns and consistent dividend payouts. Others may choose to invest in smaller, more innovative companies, which may carry greater risk but also the potential for higher returns. In addition to stocks, the UK investment landscape offers other options, such as bonds, which are essentially loans made to governments or companies in exchange for regular interest payments and the return of the initial investment at the end of a fixed term. Bonds are generally considered lower risk than stocks, as they provide more stable returns, but they also offer lower potential rewards. Many investors choose to hold a mix of both stocks and bonds to balance risk and reward. It is important to note that investing in stocks and other assets carries inherent risks, and there are no guarantees of making a profit. It is possible to lose money, especially in the short term, if the value of your investments falls. Therefore, it is crucial to only invest money that you can afford to leave untouched for an extended period, allowing time for potential market fluctuations to smooth out. In summary, investing in stocks can be a powerful way to grow your wealth over time, but it requires careful planning, a long-term perspective, and a willingness to accept risk. With the right strategy, and by taking advantage of tools such as ISAs and diversified funds, investors in the UK can build portfolios that balance risk and reward, helping to achieve their financial goals.